my returning viewers on the channel already know, but if you're a new viewer, the basic premise of the content that I put out on average is around teaching the mechanics of underwriting as well as the psychology of banks and lenders in order to leverage that information to get access to more capital, build better relationships with banks and lenders, to get access to more capital, higher limits, better rates and terms, because this leads to the fuel that it takes to build wealth in this country. That having been said, one of the biggest influences on underwriting, banks, psychologies, and lenders is going to be the economy. And one of the biggest influencers on the economy is the Federal Reserve. In order to understand some of the decisions banks make, getting denied on applications for arbitrary reasons, getting approved and getting high limits that you may not have been expected, either end of the spectrum, it is important for you to understand what's going on in the economy and what's going on with monetary policy. I'm going to give a very understandable breakdown to what's happened the last 4 years with the most influential entity in the economy when it comes to monetary policy, and that's the Federal Reserve. The Federal Reserve, for those of you who might not be completely sure, is basically the top primary bank for the United States and the United States government. They are a private entity. They are not a part of the government, but they work in tandem, lockstep with the government in influencing monetary policy. They are apolitical, meaning that they, on paper, are not aligned with either political party or agenda. They are here strictly for the money. Their primary job is price stability and keeping them balanced in the labor market, meaning influencing employment. And when I say price stability, think about not too inflationary, not too deflationary. Think about the velocity and the flow of money, the price of goods and services. So that's their primary role and that's their existence. Comment down below if you have more questions about the Federal Reserve, how they work and who they are. Other than that, hopefully that gives you a little context. The Federal Reserve is the primary determining factor in interest rates, and interest rates impact the hell out of bank lending significantly. The last 4 years, many of you are aware, even if you were living under a rock, you know we had a major health crisis in this country. I want to take a quick moment to shout out anybody who took a loss during that time frame. Comment down below if you took any losses during that health crisis that we experienced during the pandemic. Other than that, that influenced our economy globally, but especially here in the United States to the tune of probably hundreds of billions of dollars, forcing the United States government to have to take action and to implement policies to keep things in motion. That involved them influencing or coming into conjunction with the Federal Reserve in monetary policy. Federal Reserve came to the conclusion that in order to stop or at least subside a total collapse economically, that they needed to put more money in the system and increase the velocity of that money traveling through the system and make it more accessible and keep spending high as possible. So the Federal Reserve lowered interest rates and lent more money to the United States government. They just put it into existence. The government then took that money and changed policies to put that money directly in the hands of consumers and businesses. This basically put the economy on life support. So in consequence of that, they were able to sustain or abstain a collapse in the economy, keep people spending money even though they didn't have jobs, and keep businesses spending money and keep money in circulation. So that having been said, that worked out for the time period as intended. The stock market took a nosedive when this health crisis first took off. From that point in time, the stock market rebounded to a massive surplus, so on and so forth. People who were unemployed, a lot of them made more money unemployed than they did at their jobs because money was put directly in their hands. This did create inflation. Initially, the Federal Reserve said this wouldn't be a problem. The government said inflation wouldn't be a problem. They were wrong. We dove into that in previous videos. Inflation came into play in a big way. And sometime in 2022, 2023, Federal Reserve had to take action on inflation before it got completely out of control, meaning that they had to increase interest rates, which in turn slowed the velocity of money, as well as shifts that they made to their balance sheet to try to limit the money flowing into the economy and even try to pull some money out of the economy. Because all of the money in the system and at the rate it was traveling increased the cost of goods and services at an excessive rate. When interest rates had to be increased to minimize the damage inflation was going to do, this changed the business model and the risk tolerance of banks significantly. We have over 4,000 financial institutions in this country. Well over half of them were significantly impacted by interest rates increasing, especially at the rate that they increase. So what this basically means is the risk appetite your bank once had bad to lend has changed. If you were somebody on the fence with your financials when you were applying for something, a credit card, loan of some sort, they may no longer have the appetite or the risk tolerance to give you a shot. The flip side of that, if you are a prime borrower with good financials on the personal or business side, that bank now still needs to lend money to keep their doors open. It's a base of their business model. They may flood you with opportunities because you're one of the few safe bets of a borrower that they have. Massive influence on underwriting, bank and lender psychology that has taken place. The Federal Reserve, in essence, is essentially trying to increase application denials, stringent underwriting, limit who can access capital. They're directly looking to influence that because the more people who have access to capital, the hotter the economy is going to be, the more spending is going to have. We have a debt-based economy that is consumer-driven. More money is borrowed, more money is spent. The Federal Reserve's policy the last couple years has been to limit how many people get access to high-limit credit cards, to lines of credit, mortgages, so on and so forth, to decrease the money growing into circulation. It's also inadvertently putting a bigger bag in the hands of people who do qualify at a high level. You got good credit, good financials. So those of us who have good credit, who have established business credit by chance, business revenue, collateral, you have an established personal credit report, you may be seeing access to more capital than ever, potentially. It's very important to understand that the Federal Reserve and their interest rate policies and their balance sheet policies is really putting a lot of pressure on banks. We're going to cover in the next video coming out how that's going to affect policy going forward, because the Federal Reserve is on the verge of a pivot, and that's going to have a massive impact. If you're looking to get access to high credit limits, business lines of credit, business lending, personal credit cards at a high limit, you have to understand that at the time of this recording, the release of this recording, we're in a tight lending environment. And that basically means that you're going to have to be amongst the best of the best and be prepared for no doc to be limited. They're going to want a lot of documentation on average if they're lending you any kind of real money. I am a small business banker and a relationship banker on the consumer and small business side. I directly take applications, help individuals and businesses get access to credit and lending, loans. I literally have clients applying for $10,000 lines of credit on the small business side and having to provide tax returns. The clients that I'm talking about have good financials, by the way. So I want to put this in context for you. It's not a game. These banks are not taking any unnecessary risk. Even if your financials are good, they want to see that you're in the best position possible and they're minimizing risk. So I wanted to bring this to you to give context, because I promise you, this is extremely influential when it comes to your ability to access capital and when it comes to your ability to get the most out of your banking relationships. I want you to comment down below and let me know what your experience has been since the Federal Reserve has implemented these policies. I want you to let me know, have you been getting harder time during your application processes, or have you been getting more access to capital? And let me know a little bit about your financials to contribute to this story on who's getting access to capital and who's having a hard time getting access to capital. I'm about to drop the next video in this small series going over where the Federal Reserve is headed and what that means for the personal and business lending space. Other than that, to all my returning viewers, welcome back. To my new viewers, welcome in. To all my pioneers, I want you to stay focused, stay in motion. I'll see y'all soon.